Hi, this is Michael Kramer of Ma Capital. Today is Tuesday, June 3rd, and it's around 4 o'clock New York time. So there's going to be plenty of economic data still to come in the rest of this week. Tomorrow we're going to be looking at ADP. We're expecting 110,000 jobs who've been created in the month of May, up from 62,000. ISM services, we're looking for 52 versus 51.6 last month. On Thursday, we're going to get challenger layoffs, initial jobless claims, and continuing claims, also international trade. And then on Friday, of course, we'll be getting the big non-farm payroll report. We're looking for 130,000 jobs to have been created, down from 177,000. Unemployment rates expected to remain unchanged at 4.2%. Average hourly earnings expected to increase to 0.3% from 0.2%, and year over year expected to fall to 3.7% from 3.8%. We've already had some data this week. Obviously, the JOLTS data also very strong today, came in at nearly 7.4 million, beating expectations, and that led to some dollar strengthening, the euro declining a little. But at this point, the trend in the euro is still decisively bullish. And you can make an argument now that there's a ascending triangle pattern that's formed in the euro. And if that's the case, then the euro is likely to go considerably higher from here. In fact, pattern would suggest we break out and take out this high and potentially move even further up. I would say maybe towards 116, 117, maybe even as high as 119. Again, when you look at the overall trends in the euro, the momentum appears to be fairly bullish still, with an RSI that's rising. The only thing that really you could look at from the perspective of the euro, obviously, is if the economic data continues to come in strong here in the U.S., that could potentially push us lower and potentially break this uptrend. The other factor is you have an ECB meeting on Thursday, and depending upon how that goes, it could really add a tailwind to the euro strengthening further, especially if there's a hint that maybe the ECB is done cutting rates or pretty much close to it. That could be another tailwind for the euro to continue to rally. At this point, I think a lot more risk lies to the euro continuing to rally than it is for the euro to weaken considerably. But again, you need to break above 114.70, and really you need to break above this high here at around 115 to get confirmation that the euro can head higher. And if that happens, then I think there's a lot further for it to go. It's really the same story for the pound, although the pound has really been clearing some very important levels of resistance already. And you can see that really all it needs to do at this point is take out 135.5. And we're talking about, a pound that could go back to around 137.5. Clearly the pound's in a clear uptrend at this point. Not really much there isn't really much here that looks overly bearish. Obviously, if we were to slip below the 134.20 area, that would open the door for a return back to 131 or so. The other thing I guess you could point to is maybe the momentum is starting to turn a little. But for right now, there's still clearly a longer term uptrend in place. And it's hard to look at this and say, well, we're not really even overbought. The other factor is that the 10-day exponential moving average is still serving as support. So there's plenty of behind the pound potential for the pound to continue to rise. And at this point, I don't really think, I think that the momentum factor is going to continue to push it higher and probably up towards this 137.5 area. The difference between the yen and the euro and pound is that the yen has been kind of stuck at this 143, 142, 143 region. And that's one of the main differences. Also, when you look at the yen, you can really start making a case that the momentum has begun to change a little bit. And so what I would say here is that the yen really needs to break below 142.40, and it needs to do it relatively soon. The other issue is that here's your 10-day exponential moving average, and you're really threatening to move back above it. And if you break above it and you stay above it for a couple of days, that's going to be another indication that the yen is going to start weakening again. So the yen just doesn't look as strong as the pound and the euro currently. That's not to say that the yen is going to start weakening materially. It's just not the look just isn't as strong, and we need to see some sort of confirmation that the yen can continue to strengthen. And for that to happen, we need to see it break below 142 and a quarter. I'm not exactly sure how that happens or if it happens at this point. But again, it's sort of a roll of the dice at this point, because you really could make a case for it to go either way. It just doesn't have that same strength component to it that the euro and the pound have currently. Gold appears to have broken out. You can see that we had some consolidation going on. We had a pretty meaningful breakout yesterday, and while we did retrace some of it today, the key here is that we stay above this blue trend line. As long as that happens, I think gold can continue to rally and at least move back towards this 34,050 region. But really, if this is a true breakout, gold should be taking out these highs and moving substantially higher from here. Even the RSI, you can see the momentum has started to shift and turn more positive. So again, it looks to me like you have a really good chance here for gold to make a pretty big move higher, because again, after a period of consolidation, really in a couple of opportunities to break lower, it didn't happen, and so one has to think that gold continues to move up. When we look at oil, you can see that oil is getting very close to breaking out as well. 63.5 to 64 is that big region. Here's your momentum on the RSI. You clearly see that we're starting to show signs of potentially breaking out to the upside. And it looks like if we can get above 63.30 or 63.5, we can move back towards the 66 area. What happens at 66 isn't quite as clear at this point, just because we know that 66 has been an important level of support and resistance, not just more recently, but really going back, a number of years. And that's going to make it a little more challenging in terms of breaking back out to the upside. You have to think that may continue to serve as a support and resistance zone, but there is the opportunity for that to happen, and it does look like we're seeing a breakout occurring on momentum. So it looks to me like oil can probably start moving higher again. When we look at the DAX has stalled out a little bit more recently. Certainly when we look at it, we have the 20-day moving average the last 2 days acting as support. Here's our RSI. That's been rolling over a little bit. Right now, the DAX is probably limited to the upper Bollinger Band around 24,370. It would be nice to try to make a case that maybe the DAX pulls back a little bit, but every time we've tried to do that, it hasn't really worked very well. So, if we just kind of look at it again and we extend this trend line out, you can see that the trend line is in threat of breaking right now, although I can't really create a topping sort of pattern out of any of this at this point. Again, if we were to stay below the 10-day exponential moving average for a couple of days, and really if you could break support here at, call it 23,400, then things kind of change a little bit. But until you get below this 23,400, it's more likely than not that any pullback you get in the DAX is going to be a very short-lived opportunity, and the likelihood is that it's going to continue to grind higher. We haven't really seen many opportunities for it to really break down. The one thing that I'm noticing as I'm looking at this again is that I guess if you want to make an argument and say that this is a rising flag or a rising wedge, and rising wedges, when they break lower, can be bearish patterns, that would be about the most bearish thing I could come up with at this point in time for it. And again, for that really to be confirmed, you would need to break below this reading at 23,400 again. So for now, I would still say that you have to be very careful that there's further upside here to the DAX. Even though it's had a tremendous run over the last couple of years, there is more potential for further upside, just because, again, the momentum has been very strong, And if there is a bearish case, it's most likely built on this idea that this rising megaphone pattern can see a break below 23,400. And then that would open doors to some of these lower levels that have been left unfilled from the move off the April low. When we look at the FTSE, it's just been consolidating right at this 88,000 level now, bouncing back and forth between 8,700 and 8,800. There's really not much to talk about at this point. You can clearly make a case that there's an uptrend that's been formed in it. It looks also like an ascending triangle pattern, and that would argue for a break higher and potentially a test of this high in here. I mean, obviously the FTSE and the DAX both have had very strong momentum more recently, and you can see that this is also an all-time high area for it. The big test right now is if it can get above 8,800. Above 8,800, you can probably make new highs. Not much really stopping it. But again, a break below 8,700 at this point really risks a couple of things happening, because you will break the 10-day exponential moving average, you break the uptrend, and you break support, and that would open up the door to moving lower. But at this point, I mean, it's hard to argue for that happening. I think the more likelihood is that you're going to break out to the upside. The NASDAQ continues to move up. It's had a couple of opportunities to break lower, and it hasn't been able to do that yet. It's also had a couple of opportunities to break out to the upside, and it really hasn't done that yet. Today is the first day that we've actually seen it actually close at a new high. It's basically been just consolidating now since, call it, May 14th in this 21,130 to 21,475 region. So today was really the first close above that. At this point, here's your 10-day. That's obviously also been rising from a Bollinger Band standpoint. You could certainly rally back to the highs around 22,110. The only thing here to make note of is that you have an RSI already approaching 70. So there is certainly room to move back towards this upper end of the range and potentially test 22,100. The bigger question, of course, is whether or not today's move has any life to it and is able to follow through. If we're following through tomorrow, then there's really not much to stop it from going back to where it was back at the middle of February, which seems hard to believe given all the things that have happened here in the U.S. since then. But right now, the onus is really on the Bears to really prove it otherwise, because until we see this 10-day broken and we see a significant break below 21,190, the momentum clearly is on the upside. And it seemed like last week it had that opportunity and it missed it. And oddly, the last 2 days here in the markets, we've had markets down in the morning, and then they've managed to rally back in the afternoon. So the way you could look at it too is that the Bears have dropped the ball on this one. When we look at the S&P, that hasn't really broken out to the same degree that we saw on the NASDAQ. I mean, you can see we've come back up to this upper range, but we haven't been able to surpass it yet. And so until that happens again, like the NASDAQ, we're kind of just waiting to see what happens. If we can get above 55, 59, 75 or so, then we're talking about going back to 6130. But, again, that still hasn't happened. And really, when you look at what's happening here in the S&P, all we've really been doing is just consolidating sideways in a trading range. And so, again, the onus, right, and again, you really had that opportunity last week, and the market sort of dropped the ball on it. The bulls did. And now the last 2 days, like I said, the market's been weaker to start, and the bears have kind of dropped the ball. So it will be interesting to see how this resolves with all the economic data coming today and tomorrow. The Bollinger Bands also would suggest that you could rally back to around 6,075 or so. The one thing I would note is that 6,000 is a significant level of gamma in the S&P, and that's likely to act as a wall, and it could really kind of slow things down, at least from that perspective as well. So It's not really a clear case that you're going to go on and go back to the old highs yet. But if you can get above 59.75 and close there, that changes the narrative a little bit, but that's yet to happen. The Dow doesn't look really as strong as either the S&P or the NASDAQ. It actually looks to be the weakest, and that's probably more to do with the composition of the average than it has to do with anything else. Just because NVIDIA isn't as big of a component in the Dow as it is, let's say, in the NASDAQ and in the S&P. But the Dow at least needs to really get above 42,780 or so, and you can clearly see the Dow has a much further distance to travel to get back to those old highs. And even when you look at it from an exponential moving average standpoint, we're just barely above the 10-day, and you're also just sitting at the 200-day still. So the Dow is probably the weakest of the averages at this point. It certainly has the most amount of heavy lifting to do. But if you can get above 42,800, you could probably move back to around 43,900. But it probably has the most amount of work to do at this point. Anyway, I hope you found this helpful, and we'll see you next week. Bye.